You've seen high yield widening out really quite sharply. Credit markets really starting to move. People getting nervous about loans and getting out of that market as well. What do you make of the price action?
Morning, Guy. It's certainly an interesting start to the year for credit markets. We've seen IG have the worst start ever in the history of that market. High yield is down over 10. That would put it number 2 on the list behind '08. And it really is kind of interesting that nothing has really fundamentally happened within these markets to spur a move like that. And one of the most important things that we're seeing to a start like this, that's this ugly, is really that dispersion is rising across names. The market is starting to really punish those companies that underperform, those that have issues passing along some of this inflationary dynamic within their cost structure, and that's very interesting to us. I think if I were to think about the last 35 years that we've been in this business, this may be the first real cycle that we are entering in since in the last 20 years, since the 2003.
Mark, that's huge. I mean, that's a big shift, and removing that Fed put is a huge shift also. You mentioned that dispersion was picking up, which I would think mean there's more idiosyncratic opportunities. Where are they? Is it IG? Is it high yield? Is it CLOs? Is it leverage loans?
Well, I think that the theme that has been durable, that will work in the beginning of cycles, is always to be up in quality and in floating rate. So we're doing very well in that part of the marketplace. And it's really more of a defensive call. Defense wins championships.
Yeah.
Think about defense turns into offense. That defense in the fact that you're floating rate, you're not taking any sort of rate ball in here, and you're participating in that. And being up in quality, it has been relatively just a great move. Just look at loans versus high yield. Loans are down a couple points. High yield's down 10. So that outperformance is massive. And I think that continues. But again, this is more about if this is the start of a real cycle, which the market has not seen in over 20 years, the game changes. It's not this sort of dialogue that I keep hearing on the show, which is, risk on, risk off by the dips. Everything goes down, everything goes up. It's more about being a good credit picker, avoiding things that you shouldn't own, because those get punished in here. And then picking things that I think will turn around. There's certainly much more to buy right now than there was, say, a month ago.
Yeah.
And we're finding things to do that, quite frankly, we think we're getting overpaid for. But it's early in the cycle.
Okay, there's 2 questions there. What do you think you're being overpaid for? And I want to come back to the question of why loans will continue to outperform high yield. What do you think you're getting overpaid for right now, Mark?
So let's just take a look at those 2 markets from a top-down basis. So you've got high yield, which is yielding around 8%, which is certainly better than when it was at 4 or 5. But loans are probably 7.5%. Your floating rate, you're not taking any interest rate risk. You are taking some interest rate risk and more credit risk, I would argue, in high yield. So on a relative basis, that's probably a better bet. If we think about high-grade CLO debt, which is a nichier market for your audience, but just to look at it quickly, the AAA debt there is yielding over 5%. That's better than the Barclays Ag. It's AAA. You're not taking any credit risk. You're taking some vol risk, but you're not taking any interest rate risk, and you're getting paid more than the Barclays Ag. That's ridiculous to us, and we think that's super cheap. That's a great.
Do you think that credit risk that you're not taking, does those start to emerge? A lot of people got into loans because it allowed them to deal with the inflation story. But we're now moving on from the inflation story to the implications of the inflation story, which is slower growth. And I'm wondering whether loans are the best vehicle to do that with. I appreciate what you're saying about going up in quality, but nevertheless, are loans the best way to play that?
Again, I think if we are going to real cycle, Guy, this is less about talking about asset classes and more about what you do within those asset classes that matter.
Right. Okay.
So again, it's there are going to be winners and losers in all of these markets. And when we talk about being up in quality in the early part of a cycle, that's the move. So there are things in high yield, there are things in CLOs, there are things in loans that are high quality, and they should be fairly resilient in here. Balance sheets across corporate America are pretty good.
Yeah.
I mean, we don't have a real fundamental issue yet, but borrowers that are finding fundamental issues in their idiosyncratic sort of performance, they're getting punished. I mean, market's gappy. Those things can trade down. Name can trade down 5-10 points in a blink. And so it's really more of a function of doing your homework, being disciplined, taking advantage of that, and that sort of alpha by avoidance dynamic that we talk about a lot. Yeah, that's paying off in here. But on the flip side, it's like,
Mark?
Yes.
You mentioned that we're still early in the credit cycle. I wonder, how long do you think that, if we are in this kind of credit cycle for the first time in 20 years, how long do you think it actually lasts? Like, what are the phases that you're looking for?
This could be years. I mean, this is a much larger market than we've ever seen. I mean, credit as an asset class has grown multiples and multiples of the 2001 period, for example. And so it will take a long time to readjust this. I think this dynamic of the Fed put being gone, and that's kind of our view. As interest rates have gone in this long-term declining trough and now are starting to flatten out and probably go back up in general, that lack of the Fed put means that you better be comfortable with what you own. And if you're not going to get to sell it to someone else later on when rates are lower. So you better be good about your homework, and that risk premium is rising. And it's going to take a while. It will take, potentially years to get through all of this.
Wow.
Mark, one final quick question. You just talked about how gappy the market is, things moving pretty quickly. Yeah. Are you seeing any liquidity problems? Is the market functioning?
The market is functioning, but I wouldn't say it's completely open per se. High yield's not really open. You can't do a new issue CLO right now, but there is liquidity. There's a buyer at a price, and that's the reason why the market is gappy. That price at times is, certainly not what you would want it to be. And I think that makes sense, given the fact that it's a little bit early in the cycle, to the extent we adjust to this new reality of where we're at with dispersion. I think people will step in and buy some of these names. We certainly are looking at a lot of rel-val names that are higher quality, that are down 4 or 5 points, and we think those are a buy. So as that starts to happen, you will see a better functioning secondary market, a little bit more flow, and the bid ask will come in.